oil is very inflationary. Oil is actually one of the commodities that is most tied to and correlated to inflation expectations, meaning as oil rises, because energy goes into everything around us, the price of everything else likely rises, or at least the expectations increase.
Branden Ducharme is an investment advisor representative of and offers investment advisory services through SCF Investment Advisors Incorporated, an SEC-registered investment advisor, 10150 Meanly Drive, first floor, San Diego, California, 92131, 800-955-2517, www.scfsecurities.com. SCF Investment Advisors Incorporated and Ducharme Wealth Management are separate entities. The information in this podcast is current at the time of recording. It is based upon sources and data believed to be accurate and reliable. The information, opinions, and forward-looking statements expressed herein are subject to change without notice. Moreover, all comments and opinions voiced herein are for informational and entertainment purposes only and are not intended to provide specific advice or recommendations and should not be interpreted as such. Further, the opinions expressed are Branden Ducharme's and his guests and do not reflect the views and opinions of SCF Investment Advisors or any of its affiliates. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what is appropriate for you, consult your financial professional. This information is not intended to be a substitute for specific individualized tax or legal advice. Ducharme Wealth Management and SCF Investment Advisors do not provide legal or tax advice. These services are provided by separate entities. The guest speakers featured in this podcast are not affiliated with SCF Investment Advisors, nor are they affiliated with Ducharme Wealth Management unless otherwise indicated.
I appreciate you hopping on. Always it's super cool to have guests like yourself and surround myself with people like this. I learned about you first through the name organization and your award-winning paper where you looked at gold and relative to lumber prices as kind of a risk-on, risk-off tactical signal. And the thesis of that paper, correct me if I'm wrong, was basically that lumber is your proxy for housing starts, right? Which is a main driver. Real estate is such a big driver of the economy. And so when lumber, the price is trending up in lumber, it's indicative of home builders buying lumber and needing lumber to start more homes, right? It kind of goes along that path. And then when that kind of peels off and gold starts to trend up, that's your kind of your risk on, risk off situation, right? There's that flight to, is it fair to use the term like flight to safety in gold?
Yeah, flight to safety, flight to quality.
Yeah.
I think you described it perfectly.
Yeah, cool. So super cool paper. Enjoyed reading that. And then one of the things that you've been talking about a lot lately that I'm familiar with, but not an expert on, is this what's called a carry trade that is potentially introducing a lot of leverage into the system. And for those of you listening, a carry trade is a very complex trade. It is not something that your average person is going to put on, or even would be able to figure out probably how to put on this type of trade. But institutional traders, big banks, maybe pension funds, maybe, but just other large institutional and Forex traders in particular, probably. It's a very high risk trade. When you start implementing it with any type of leverage, there's risk even without the leverage, right? Just like any investment strategy. So I want to make it very clear that I'm not condoning this trade. I'm not saying that people should try to replicate this trade or participate or any of that. I just want to have this conversation with Michael here about what the trade is and the potential implications that it could have on the broader markets as a whole. With the Fed's potential shifts and pivots that could be on the horizon, right? So with that being said, Michael, you're a CFA, a chartered financial analyst, institutional manager. You've been around for a long time and have written some award-winning papers based on your research. That being said, is there anything else you'd like to introduce yourself as before I ask you to kind of start to help us understand what a carry trade is?
Yeah, publisher of the Lead Lag Report, which is basically a premium research service I put out there, separate from, my own role as a portfolio manager at the RIA that I'm a part of. But But that's the primary thing. Most of my social media content and all this stuff is from at Lead Lag Report on X, Instagram, all that stuff. I appreciate the way you described it because we'll get into it, but while a carry trade sounds like a complex term, it's actually, I think, deceptively simpler if you kind of boil it down. And it's not. I don't think the purpose of the conversation is to scare anybody, but rather just to make them aware that there are these things that can result in volatility, and that at least it's good to just keep in the back of your mind if you're going to take on a new position in a risky asset.
Yeah. So let's start with, well, I don't know what's the best way. I want to take this conversation, and so often in our industry, we have these conversations amongst ourselves as industry professionals or traders or people that are really involved. But there's all these people out there that they don't know and they don't understand it. And that's when I think people say, well, the market is risky. The market is this, the market is that. Right. And it's because they don't always really understand. But when they look to the pros, if you will, there's all this jargon, there's all this complexity, and it is a complex system. The financial system is very complex, and it is almost needs to be, right? But what is the before we get into the leverage or any of this, like what is the very basics of what somebody calls a carry trade?
Okay, so money flows right all over the world, and if you want to borrow money, you don't have to necessarily borrow it in your own country. Right? I don't have to go to a bank here in the U.S. I mean, with enough work, I could go to a bank in Brazil. I go to a bank anywhere in Europe. I go to a bank in Japan, and I can borrow money. Right? I can convert my dollars into that currency, pass all the checks, and borrow from some other country. Just like any other borrower out there. Okay, now obviously, if you're borrowing money, you want to get the cheapest rate. Right? You don't want to pay interest as much as you can. You want to keep it as low as you can because you want to deploy that borrowed money somewhere, right? To hopefully earn larger returns. Now, Japan, for decades, for a lot of reasons, has had to deal with disinflation / outright deflation, meaning that being in this kind of falling price environment, which in turn means very low rates, negative rates. And again, I go back to anybody can borrow from anywhere in the world. So if you're in the US, you're an institutional player, right? You want to borrow some money because you want to take a bet on something. Well, hey, I mean, I can get some pretty cheap leverage from Japan because their interest rates are as low as they are, and certainly against the US now.
And so just to define, like the leverage piece is just the anytime you're borrowing money, you're taking on leverage, right? So whether you're if you borrow money for a mortgage to buy your home, that's leverage. The borrowing in and of itself is you put a little bit of money in and somebody else is giving you a bunch of money and you've bought something. That's what leverage is.
Right. Okay. Exactly right. And so which means you owe that money.
Yep.
Right. It's obviously the key point. So your hope is, okay, you borrow this really cheap money, and you're borrowing it in yen, in this case, because you're borrowing it from Japan, meaning you have to actually have it in their currency. And hey, you know what? This cheap money, I can go somewhere else across the globe and make a higher rate of return. So I can make a differential between basically no interest expense or extremely low interest expense on the Japan side. And maybe I can deploy that in the US somehow, or in Europe, or in other parts of Asia. Right? Maybe I can buy stocks with it. Why not? Right? I get it basically for free. I don't really have to pay for the interest. It's very minimal. I can make a spread, right? Adjusted for risk. Okay. Now, that's not a riskless transaction because even though the interest rate that you're borrowing in yen is low, you're still exposed to the currency. Because when you're borrowing in yen, you then convert it back into your own currency, dollars. Okay. Now, I know this is going to sound maybe a little bit complex, but I think it's very important for people to understand that when the yen is dropping and you borrowed in yen to begin with, you as the borrower actually benefit. Now, why do you benefit? Because you're borrowing a set number of yen. The currency is weakening. Okay, your currency is getting stronger relative to that. And if that's the case, you're actually benefiting because it doesn't take as many yen adjusting for your currency to pay back that set borrowed amount. So you actually get a benefit from, if you're borrowing in yen, the yen depreciating against the dollar. That, of course, works the opposite way as well. In other words, if you're borrowing in yen and the yen is now rising, well, suddenly now that actually eats away at your return because you need to convert into a stronger yen currency against that set fixed yen amount that you borrowed. So the key thing here is the interaction of the amount that's being borrowed, where it's being deployed, and then how the currency conversion factors into the repayment value of what you borrowed from, in this case, Japan.
Okay. So I'm going to try to recap this and just bring it down and talking just simpler terms and try to put some numbers to it, right? Just to make sure we're on the same page here and people are following along. So if I go down to, I don't want to use a currency in particular. So let's just say a yen currency, right? And I borrow 100 yen from them, and I convert that back into, our currency here in the US, the dollar. And the exchange rate's going to be off here, but let's just say it's you get what do you want to say, $50 for 100 yen, right? And now the yen is falling, but you don't have yen, you just owe yen, you have dollars. Right. So now as you go to and say, so now you do whatever you're doing in the dollars, right? Or maybe you just hold the dollar, right? And all of a sudden you see, well, the exchange rate has kind of shifted now because the yen has depreciated against the dollar. So now with my it only takes $40 to go get 100 yen and pay off my loan. That is essentially, that's the trade. That's the ideal situation. Right. That's how it works out on the upside, right? Now, if it goes the other way, and all of a sudden you say, well, I want to close out this loan. I have the $50 I borrowed and the yen has appreciated relative to the dollar. They might say, well, you need $60 to get 100 yen back and close out that loan. In which case you've kind of lost $10, right? So you can make and lose money on this trade depending on how strong or weak one currency gets relative to how strong or weak the other currency gets. And they both are constantly moving and can move in either direction.
Exactly right. And then when you factor in what that money was deployed into, so you borrow in yen, you have the currency volatility, but then you have also the volatility of the underlying asset. Let's say you're going into US stocks, and there is an interesting correlation between the yen and the NASDAQ, or whatever it's worth, meaning that they tend to actually move together.
Okay.
So yes, you benefit from the move in stocks, but now, using that scenario, the yen appreciates. Let's say it appreciates slowly. Okay, you as the borrower have time. If it's a gradual appreciation in the yen, you don't have to sell your tech stocks tomorrow if that's where you deploy that borrowed money into in the US. But what happens if the yen starts to spike, meaning you get a very aggressive move higher in the currency? Well, now you might panic because it's eating away at your return, and you're afraid that that spike will continue, meaning the yen will appreciate even further. So you know what? Maybe I shouldn't then have that. I shouldn't be borrowing in yen. Maybe I should pay back that loan because the currency is hurting me. So what do? Well, if that borrowed money was in the NASDAQ, you have to sell to get your dollars back, to convert it back to yen, to pay back the loan. Now, take that to a logical extreme. Because that's borrowed money, and because a lot of other institutional money will then start to see and do the same thing. First of all, it adds even more increased upward pressure on the yen. Because remember, those people have to buy yen to pay back the loan.
Right. So when you borrow money from the yen, you're effectively short.
Right.
And
exactly right.
and again, not defining which yen, I don't want to at least, which yen, but just yen as a proxy for a foreign currency here. If you borrow that money, you're effectively short, right? Because you owe it. Right. So if a lot of people have to rush into buying that currency, it creates the same or similar effect as what can be called a short squeeze, right?
Squeeze. Yeah, that's exactly right. And the issue there is it makes the spike even more violent, right? Because it's basically just suddenly, which then causes more panic, of more unwinding of that borrowed money from yen deployed into U.S. equities, as an example. And so you can see how that creates sort of this self-fulfilling spike higher in the yen, right? But if that all happens at the same time, or in a relatively short time frame, what's the implication? Well, now there's selling pressure on the underlying assets that borrowed yen was put into, which again in this example would be the Nasdaq. So you're creating this concentrated selling pressure because of the concern that the yen could squeeze higher.
And so if you're in this trade and it's coming unwound, and you're short a foreign currency and you're long financial assets in the U.S., you see the cost of borrowing go up here, basically on the short side of your ledger, and you would see your returns of the value of your position on this side of the ledger and on your long side go down. So you're kind of losing all of a sudden on both sides of the ledger in both directions.
Right. And that's what creates a panic. And that's really what the reverse carry trade effectively is. Now, to be clear, it's not like everybody is doing this. There are certainly players that hedge the currency, meaning, they're trying to take out the currency movement. But the reality is, because the yen has been so weak, it's been a great trade. You get the double whammy of the yen weakness against, higher yielding assets you're deploying that borrowed money into. And because interest rate differentials have been so significant between, in particular, the U.S. and Japan, which only now is basically at zero rates, right, with their first hike, it makes sense that the currency would be weak because you have this huge differential, right? Everyone wants to short against, 0% to get, the 5% they can get from the U.S., right? Now, in a very levered system, it doesn't take very much for volatility to rise. You just need, at the margin, some forced selling, which would happen with money that is getting nervous and that may, from their risk control perspective, say, we need to reduce our exposure to the yen that we're short against, right? And that's where the whole butterfly effect, what I call the Mothra effect on X, which is a play on Godzilla and Mothra, that flapping of wings in terms of forced selling has all kinds of implications and domino effects on everything else, right? And that becomes the spark for broader volatility. Now, I could be totally wrong that this is a viable scenario in the short term. The issue is that I don't think people really appreciate, in general, how much leverage Japan has enabled for decades. Okay. And they've been able to enable that leverage because they never had to worry about inflation. Now they do, in a very shocking way. Aside from the fact that wages have increased meaningfully, Japan imports all of its oil. Okay, so now this is where it gets to be, I think, really interesting to kind of think through, and why it has implications on so many other things than people realize. Japan does not, unfortunately, have the benefit that we have in the U.S., where they have domestic oil production. A lot of the nuclear reactors were shut down post-Fukushima, which was a big driver of their own electricity needs. So they import all this oil. Now, oil is priced in dollars. As oil rises, again, it's priced in dollars, Japan has to convert yen to dollars and then back to buy the oil. Right? They have to their own currency conversion just to be able to import oil. The weaker the yen gets against the dollar, the more the price of oil rises in yen terms. So it actually becomes more expensive because the currency is weaker.
So as
for
their
every
as their
barrel of oil.
currency. So just to clarify, so in Japan, and again, I just want to try to simplify this down
Yeah.
to make it digestible. So I'm going to talk yens like as if they're dollars for just a minute, and I'm going to use like U.S. prices, so it's familiar sounding for people. So what you're saying is if you were buying gas in Japan with your yen for $4 a gallon, and yen has now depreciated further, and maybe not even really depreciated, but just relative to the country where you're buying the oil from. And in this case, we're going to say, we're going to use the US for as an example. You may now have to actually buy it at $5 a gallon. As an example, not because your currency did anything wrong, but because the other currency just got stronger and you have to buy it in that currency. You can't buy it in your own currency. I'm tracking, right?
Yeah, no, that's
Perfect.
exactly right. Right.
All right.
And the issue there is oil is very inflationary. Oil is actually one of the commodities that is most tied to and correlated to inflation expectations, meaning as oil rises, because energy goes into everything around us, the price of everything else likely rises, or at least the expectations increase. Because the idea that oil rises, well, you know what? If you're the manufacturer of some good, you're going to pass that price down to the end consumer, right? Okay, so yen weakness against oil is inflationary. Now, what happens if
and inflationary in Japan?
In Japan,
inflationary
right,
in
in
the US.
Japan,
Okay,
right,
so I just want
in
to
Japan,
okay,
right.
just to clarify. So inflationary in Japan. Okay.
Right. Okay, now what happens if, as that's happening, you have war in the Middle East and oil prices start to rise very quickly because there's concern around, either an embargo or something else, right? Just it's a disruption as far as global oil flow.
Yep.
So now oil is rising at a faster pace while the yen is weakening. So now there's a double whammy, right? If you're in Japan, not only is your currency not allowing you to buy as much oil, you need more of the currency to buy it, but on top of that, oil is going up on its own in dollar terms, which means suddenly you have a real issue for the economy. Then the price of energy is skyrocketing in Japan. Now, Japan can't control the price of oil. The only thing they can really try to do is control their currency. That way, at least if oil is rising, maybe they can get the yen to go up with some intervention so that it does not have that double whammy effect, that maybe the strengthening currency actually can bring down or at least make the rate of the oil increase in yen terms slower, right? Which is why I keep saying, going back to this reverse carry trade, I think the Bank of Japan will panic to intervene because they see that the price of oil in yen terms is then skyrocketing. And they have to then cool that off against very low interest rates still, with now inflationary pressures really rising, again, in a country and in a culture that does not know how to deal with that. Right? That's the risk. The risk is that they are forced to act so aggressively that it creates all those borrowers of yen deploying that capital into other assets. It causes everybody to suddenly panic and causes the yen to spike in a shocking way.
Yeah.
Right? Now, it's a scenario. Doesn't have to happen tomorrow. I happen to think the risk is, probably closer than not, because the more the yen weakens and the more that we hope that obviously the Middle East dynamic doesn't get worse, but it's not exactly looking very optimistic at this point. It forces the hand of a major printer of currencies, right? Now, if I'm right about that, the implication would be you're going to have a lot of volatility everywhere, right? In currencies, in stocks, in bonds. Now, going back to what you said in the beginning of the conversation, if you're a retail investor and you're not looking at markets every day and you don't need the money, none of this probably matters, right? It's like you got a 20-year horizon. Believe me, there's going to be many more crises than just this one.
Oh, yeah.
That plays out, right? But if you're one of those investors or traders or whatever you want to call it that gets nervous in the short term, or you have money that you need to deploy because of some life event, at least I hope me presenting this sort of, or sounding the alarm on this sort of being a viable scenario, you might want to take a little bit of risk off the table, take some chips off the table, right? And at least lower your volatility profile, just in case, right? It's like I always go back to, it's far better to slow down entering the storm than to outright stop or go backwards, right? It's just downshift your speed, right? Again, if you have a long-term horizon, it doesn't matter. But if you're worried about short-term movement and you need that capital, and if I'm right that it plays out that way, there's nothing wrong with just playing a bit of defense.
Yeah, and I think everyone should always talk to their obviously talk to your own financial advisor or your own financial professional about the risks that your portfolio does or doesn't carry.
Right.
And I think if you have a financial advisor but not a financial planner, you want to make sure that maybe you engage with a financial planner as well. I think some of the best risk management in portfolios comes from the behavioral side. I do believe that, and that comes as a result of people having a plan, right? So I kind of always go back to that. If you know you're deploying capital in the next couple of years, have a plan of having that set aside in somewhere that you don't have a risk on that money, or you have a way to punch out, whether it's different, I don't know. There's a lot of different ways to do it, right? There's a lot of different ways to manage risk in portfolios, but I think a lot of it can be mitigated for the what's called the retail investor, right? I just want to highlight what I mean is by that is the average person, and not to say that anyone out there is average, but you're not the non-professionals, right? These are the people with IRAs, 401ks, maybe some inherited money. You have money put together from some, reason, whether it was a business exit, retirement savings, whatever. But you're not a professional trader, and that's okay. Most people aren't. You can manage the risk a lot of times from the behavioral side before you need to even be worried about this kind of stuff. Right. But you also need to really have a good understanding of what risk you still carry in a portfolio. Right. And I think that's because it goes back to the saying, like the Mike Tyson quote, right? Like everyone has a plan until they get punched in the face. Yep. And everyone always says they're a high risk. Everyone always says they're a high risk investor until they experience volatility.
Yeah, they're high risk when things are going up.
Yeah.
I mean, that's the reality.
Yeah, things are going up. Hey, I'm really high risk. Yeah, I'm a super risky person. And then, 10% correction comes and all of a sudden they want chips off the table, right? So right. You need to be real with yourself ahead of time. And what interests me about this trade or about this whole scenario isn't per se that, this is going to doom the markets or, this is going to cause people to lose their all of their assets and, take action today or something like that. I think if anything, I would say the opposite, right? If you're unsure of what to do, it's probably best to stay the course typically, on the long-term plans you had already set in motion. But there could be some significant volatility of this trade unwinding, but what happens after trades like this become unwound? Maybe that's worth talking about is, okay, so it comes unwound and all this leverage comes out of the system and it kind of resets everything. I believe that's a fair description of something I would call a correction.
Yeah, correction. It could be, the difference between a crash and a correction is just speed, right? A crash is more contained and correction is longer. And I think of it more in terms of sort of how many months do you give back as opposed to percentage. Mm-hmm. Like how many months of a gain do you give back as opposed to this arbitrary 10% type of number. Look, it's not a bad thing. Investors should want to buy things lower, right? Because time is on your side. You have an income stream. You want to do dollar cost averaging. You ideally want to do dollar cost averaging when stocks are going lower, because they're going to go higher longer term, right? So you might as well have time on your side to accumulate as much as you can on a decline. So it's not like one of those things where I'm certainly not arguing that stocks stay down, right? What I'm arguing is that there's an air pocket potential, right? That can afterwards, even though it's going to be really scary, would be a phenomenal buying opportunity, right? Now, the buying opportunity, I think, would be you always want to think in terms of, where's the dislocation greatest,
Mm-hmm.
right? Because that's really where you want to get the juice of your returns, right? Where is the dislocation greatest? If I'm right that this scenario plays out, then you're going to get volatility spiking, and you're going to get credit spreads widen. Okay, so what are credit spreads? Basically, it's the differential between a really poor quality company's debt and a high quality company's debt. So there are these ratings, triple C versus triple A, right? The difference is, the triple C has higher risk, which means if you are lending money to some borrower, you may not get your money back. There's default risk, or at least you're getting less back.
So to put that in context for our non-institutional friends here,
right.
That's basically the difference between saying I'm going to borrow money to, borrower A that has a multiple six-figure income salary
right.
with a profession that is very recession resistant and a 750 plus credit score, and I'm only borrowing half as much money as they needed, right? Versus I'm borrowing, money to the person that changes jobs every 2 months and they're trying to buy a used car with an extreme interest rate, and it's going to be half of their monthly income to pay for this car that might actually just break down in a couple months anyways. And what you're saying is that should be two different profiles where obviously, borrower A from a fundamental standpoint should get a significantly better terms on their loan than client B. And I think in talking about that as the credit ratings is like a credit score that most people are familiar with, it's a difference between a 750 and a 500 or a 750 and a 600, quite significant difference. So when you convert that to, corporations, that's when you come up with, AAA, AA plus, Bs to triple Bs, then you get down into the Cs. And so the credit spread is the difference between that, 550 credit score guy and the 750 credit score guy. And if they're both paying the same interest rate, okay, your credit spreads, that's the difference. That's what's called the credit spread. Right. That's really tight. There's, client A is paying 5% and client B with the really bad credit score is only paying 5.25.
Right.
Okay. That's a really tight credit spread. That's what, okay.
And that's a mispricing of risk, because if you may not get your money back, why would you want more yield? More, if you're lending money, you want a higher interest against that 500 FICO score, credit card guy. Okay, so which means it's really about the perception of getting your money back, which is default risk, bankruptcy risk, right? Okay, so there is a strong relationship between volatility in equities and that differential rising. In other words, when things are calm, volatility is low, the economy is phenomenal, you're not going to worry about default risk because there's so much liquidity. There's so much money sloshing around. Things are good. You know what? This guy, he might have a 500 FICO score, and he may be unemployed now, but everyone's hiring. So he'll be fine. I'll get my money back. Well, the thing is, if volatility is increasing and the economy gets also dicier, that likelihood of that guy who's unemployed getting another job isn't really there. So you now start demanding more yield. That creates the widening. The differential starts to increase. Now, so this goes back to the discussion around what's the opportunity. Because
before we get there, can we just really quick translate that down into what does that mean for the average person a little bit? Like, how do they see credit spreads widening sort of show up when they check their IRAs, 401ks? What does that sort of look like?
So generally, it looks like stocks going down.
Okay.
Because
the correlation.
Because of correlation, right? So I mean, if somebody happens to own high yielding bond funds, right? Suddenly the yield will look a lot higher.
But the price
will yield look higher because the price is going down.
The price is going down, and the credit spread widening could happen from two different ends. The your high yield, or often referred to as junk bonds, the yield could be going up on that, which means the price is coming down. But also that could remain relatively almost the same, and you could have a movement in yields on the high quality end. Correct. And less likely to happen. It could, but more than likely, what's going to happen is you're going to check somebody would check maybe their account and see that maybe a mutual fund or something to that effect that has their bonds in it would all of a sudden be going down in price.
Right. Now, we are at this stage where that differential is very, very tight. So if you have volatility increasing, junk debt becomes junkier, meaning yields rising, the price falls on those junk bond funds. Spreads widen. And at some point after the volatility, they will compress again. Because if spreads widen too much, you're going to see in the economy, you're not going to see as much money being lent to a lot of companies because there's fear that you may not get that money back. So what does the Federal Reserve do? They come in, they liquefy, they lower rates, they take actions to try to close the credit spread. All right. Now, that's why that actually becomes the opportunity, because after that volatility spike, after the spread widening, there would be, high yield bonds which are selling at very low prices at very high yields, which is probably when you want to scoop them up, right? Because the bet would be that you'll have some kind of stabilization that comes in afterwards, as the Federal Reserve does what it always does, which is act to step in, right? And prevent things from getting even crazier. Timing, that's always tricky, but the point is you can get some real nice yield after that scenario plays out, right? So it's like if you're an income investor, this could be a really exciting time because you might be able to pick up some incredible yield, but you need to have the pain and the spread widening first before you do that. So
you got to stay in the game.
You got to stay in the game and at least be aware, right? If you're going to be, opportunistic, right?
Yeah. You have to be aware. You have to be watching. You have to have some kind of resource ready to go, or assets identified that maybe you would hope are non-correlated to this type of thing that you would be able to liquidate when the timing, feel is right, and kind of rotate into that scenario. If you're not that person, buckle up. What I kind of, to reiterate what I think you just said was, if you see these credit spreads widen, and now we've said, okay, well, that probably comes in the form of checking your account, your brokerage account, and seeing that your bond mutual funds or ETFs or even direct position bonds, the pricing on those is going down, right? So it feels like you have less money in your account. Meanwhile, you still, unless there's default, you're still going to get the yield that you were always promised. And that comes not on a percentage. The yield really comes in a fixed rate. For the most part here, right? Like your yield is just a derivative of how much that dollar is coming in is relative to the current price of the bond. And so after it widens and you see your price go down, you still get the yield. And then the Fed, your theory is that the Fed would act and essentially you see that credit spread retighten, which means the price is going to come back up.
Right.
So,
and you have that yield locked in at that point.
Right. So very, very painful roller coaster to ride from an emotional standpoint of watching your assets go up and down and up and down. However, it could, if you don't have the ability to take action and do something else when this type of thing is going on in the markets, you want to probably know what's going on for the purpose of being able to say, okay, I need to not make a foolish decision here and sort of ride this out.
Yeah, and also, it's just a good reminder of why rebalancing makes sense.
Yep. Okay.
Because if you're rebalancing, you're buying, you're effectively selling your winning area, your winning asset class, and then buying the losing asset class to get back to some normalization of target weightings.
Yeah.
So as spreads widen, the implication would be if you're rebalancing, right, against AAA, you're going to be selling AAA and buying junk as, junk debt or high yield as the yields are rising. So that automatic rebalance, that's another reason why automatic rebalancing makes a ton of sense, because despite me sounding the alarm around sort of near-term risks, I could be totally off on the timing, still right on the destination, not the way you get there. But the rebalancing will handle that for you.
Right.
Right. And that's a big difference between somebody who's active and tactical and has more of a trader mindset versus a much more 20-year type horizon.
Right. Well, I think a lot of times too, people, the most common rebalancing that I see that most people actually get is what I call a calendarized rebalancing, right? Once a quarter, their account's rebalancing, typically because that's what their, advisor, financial professional is doing. And it doesn't really kind of matter on that day if the stocks, are way up and the bonds are way down or vice versa or whatever. It's just like, oh, it's the last day of the quarter or whatever. Today is when we rebalance. And I think what you're highlighting is that can leave a lot of opportunity on the table because if intra-quarter, right? Like if you look at, now this is almost a poor example because it happened so close to the end of the quarter, but COVID as an example, if that had happened, let's say that happened 4 weeks earlier, like in the middle of February,
right.
Your portfolio would have missed its opportunity to rebalance and grab, all that extra upside capture when the market kind of rebounded, right? If you were saying, well, I'm going to wait till the end of the quarter to do my rebalance. So that's the difference between a calendar rebalancing and a systematic rebalancing. And I am a big fan of systematic rebalancing for that exact reason. Yep. Super good point. I didn't think you were going to bring that up today, but super valid.
No, it's important because it's like the question with all this stuff is, it's like, what do you do with the information?
Yeah.
Like, we're in an industry where everyone's talking and has an opinion and everyone's great analysis. And I'm among that crowd too with my own research, right? But it's always about, well, what do you do with it, right? I mean, you can either take a proactive stance, in which case you hope the cycle favors the way you're expressing the trade.
Yeah.
Right? Or you just say, you know what? I recognize this is something that can happen. I have a set asset allocation. I'm just going to have this be automated and I'm not going to stress because even though you have the rebalancing, it's still going to be painful. Right, you're going to have a drawdown. You're going to lose money during that period. You're going to be buying into the decline, and that decline could get worse.
Oh yeah,
right, which is a whole another psychological aspect to kind of keep in the back of your mind. But it's just two different types of ways of thinking about how to manage risk.
Mm-hmm. Well, I think risk in portfolios is so mismanaged, oftentimes, anyways, especially for just the mass affluent of the U.S. The 60-40 portfolio, built up on a standard Sharpe ratio, I think is, and I'll probably catch a lot of flack for saying this, but I don't think it's the end all be all. I don't think it's the best way to manage a portfolio, even if your focus is on, low cost index funds or whatever that's your approach. I think it's always a question of, okay, well, what index still? Because all an index is, and people forget this, is an index now is just, it is an actively managed strategy that is systematized. And so now people replicate it within a fund and it just becomes cheap. So it is still a form of active management under the hood, right? That selection of, well, what's in the index and how does it get there? That's technically an active process. And people like it because it performs okay to the upside, right? The return performance is usually pretty good, especially in the US. Outside of the US, maybe not so much. They completely disregard the risk and they build this portfolio. Well, I want a little bit of this index and a little bit of that index. Oftentimes you look at it and say, well, the correlations are actually quite high. I'm not really sure you're getting the diversification out of this that you're looking for anyways. And then you get to bond indexes and that's a whole nother, animal, right? If you look at like the effective duration on the egg that had just creeped up and all of a sudden, you end up with 40% of your portfolio is a mixture of bonds that have, all the downside risk, very limited upside risk, and it's carrying very little yield. It's not doing much for you. Like that's a huge mismanagement of risk in a portfolio. People have learned that the hard way now since 2022. And I think that's what you're coming back to now is like, so what do you do with this information, right? There is this possibility out there. And I think what you do with it is you understand what's going on in the markets because I think it can help people just weather the storm a little bit easier emotionally, right? I think we know, and I think it's commonly understood now that if you sold your entire portfolio at the end of March of 2020, it turned out really bad for you. I mean, that's really bad. Now, if you sold earlier in March and got back in at some point or something, right? You make tactical moves. That could have worked out. It might have worked out, but if you understand what's going on in the markets and how leverage is becoming unwound, this or that, and what the Fed does and how that affects, it helps you just say, okay, look, I don't understand everything about this, but I understand that I need to not make rash decisions. I should talk to an advisor that understands what's going on. And it's going to probably be okay if I have a long enough time horizon, right? And that's always a big if, but if I have the time horizon. And then the second piece of information is, well, if you're ready and you're looking for something like this and you are in a position where you can make, strategic moves and reallocations and do stuff like that, there might be some really good opportunity when everyone else is scared, right? And that's the old Buffett quote, be fearful when others are greedy and greedy when others are fearful. And so as, major things come unwound and the system's deleveraging and there's, correction, crash, whatever you want to call it, like there's that big price change in the market, might be your opportunity. And I heard, gosh, I got to remember who said this. It was at the last NAME conference in Chicago last fall. And they said the best trades you'll make in your entire career will be the most difficult to take.
Oh, of course. Yeah. I think Walter Deemer said something along the lines of, but by the time when it's time to buy, you won't want to, or something along those lines.
Yeah.
Right. Which is spot on. Goes back to the rebalancing, automation, and just having a systematic approach, because you have to not be emotional. Now, you can communicate emotionally. It doesn't mean you act emotionally.
Oh yeah.
Right?
Well, I think anyone that follows you on Twitter knows that.
Yeah, exactly right. I mean, I'm inherently I am a quant and rules-based, manager, and the way that I think about things is actually using things that I know has some degree of back-tested proof and evidence behind it. But you gotta play the communication game too.
Yeah. And just to touch on the back testing thing, I assume your research is back tested. You're not saying that you have a strategy per se or something off the wall that we're saying is back tested. Anyways, it's more about knowing what works. Right? Yeah, research is back tested. Right. Anyways, I think we covered a lot, and I think at this point, people either think we're both a little crazy, or they're starting to yawn. One of the two. But I really do appreciate you taking time to come on and chat and explain this. I think the part we didn't get to is maybe some of the complex things that people do once they actually enact this carry trade and the deployment of leverage and into assets that would oftentimes be viewed as relatively safe or more stable assets. And that's a whole nother layer of complexity. But I always am wishing people the best experience possible with their portfolios. And if you see volatility, it's not something that happens. There's a behavioral quote. It's not something that happens to you. It's something that you just observe, right? Yeah. So I'm not a buy and hold guy really myself personally, but if you are, and stuff like this happens, I encourage you to stay the course. I encourage people to always stay the course to their long-term plan and long-term strategies. So, anything else you want to add before we wrap it up? I think it's just, look, it's always good to self-educate and be aware of things, right? So I'd encourage anybody that's listening, spend the time just researching some of these things that we talked about, and, feel free to follow me on all these different social media platforms, recognizing, again, to your point about the communication style is certainly unique on X as a persona, but it is effective. Not PG rated.
Well,
most of the time, but
most of the time. That's right.
But certainly a persona, and if you have a good sense of humor, you might be able to pick it up. Anyways, big thanks, and I look forward to continuing to see you around, Mike.
Yeah, no, I appreciate this. Thank you.
References to securities indices such as but not limited to the S&P 500, Dow Jones Industrial Average, NASDAQ Composite, MSCI, EAFE, and Russell 2000 reference an unmanaged group of securities considered to be representative of segments of the stock market or overall stock market. These indices may be market weighted with the largest companies in the index representing a disproportional percentage of the index. Investors cannot directly invest in an index. Any hypothetical example contained in this document are for illustrative purposes only. They do not represent the past or future portfolio composition or performance of any specific investment and are not intended as investment advice. We suggest working with your financial professional to see which allocation opportunities may be right for you. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than the original cost. Asset allocation and diversification are approaches to help manage investment risk. Asset allocation and diversification do not guarantee against investment loss. Past performance does not guarantee future results.